The global energy market woke up today to a headline that instantly recalibrated risk: reports of a potential U.S. strike on Venezuela. For oil traders, policymakers, and investors, this is not just a geopolitical flashpoint, it is a supply-side shock waiting to be priced in. Whenever military action intersects with energy-producing regions, markets move before facts are fully known. And the first question echoing across trading floors is not whether prices will react, but how fast and how violently. History tells us that oil does not wait for confirmation. It responds to fear, expectation, and disruption long before the first barrel is removed from the market. Venezuela sits on the world's largest proven oil reserves, yet years of sanctions, underinvestment, and operational decline have already tightened its effective output. A U.S. strike, even a limited one, would instantly raise the probability of further production outages, export disruptions, or retaliatory actions that complicate shipping routes. The hook markets cannot ignore is this: when spare capacity is already thin, even a small perceived loss of supply can trigger outsized price reactions. Oil prices are not driven solely by barrels lost today, but by barrels investors fear may be lost tomorrow. That fear feeds directly into futures markets, lifting prices before physical shortages appear. Beyond Venezuela itself, the ripple effects would spread quickly across global supply chains. Refineries configured for heavy crude, particularly in the United States and parts of Asia, would face immediate challenges sourcing alternative grades. Substituting Venezuelan crude is neither fast nor cheap, and every adjustment introduces inefficiencies that raise costs downstream. Shipping insurers would reassess risk premiums, freight rates would rise, and delivery timelines would stretch. Each of these pressures compounds, transforming a regional event into a global pricing mechanism. What begins as a military headline rapidly becomes an inflation headline. Global markets would not absorb this shock in isolation. Higher oil prices feed directly into transportation costs, manufacturing inputs, and consumer energy bills, reigniting inflation concerns at a moment when central banks are already navigating fragile economic conditions. Equity markets, particularly sectors sensitive to energy costs, would feel the strain, while energy producers may see short-term gains offset by broader market volatility. Emerging economies dependent on oil imports would face currency pressure, widening trade deficits, and increased fiscal stress. The hook here is uncomfortable but critical. Geopolitical energy shocks rarely stay contained, they migrate into monetary policy, growth forecasts, and political stability. For policymakers, a U.S. strike on Venezuela would complicate an already delicate global balance. Strategic petroleum reserves could soften immediate price spikes, but they cannot offset sustained supply uncertainty. OPEC and allied producers would face renewed pressure to stabilize markets, yet their willingness and ability to respond remains uncertain. Markets understand this hesitation, and uncertainty is the most expensive commodity of all. The longer clarity is delayed, the more volatility embeds itself into prices, contracts, and expectations. As the situation develops, investors and governments alike will be forced to confront a familiar, but often ignored reality. Energy security and geopolitical stability are inseparable. When military action enters the equation, oil becomes more than a commodity, it becomes a barometer of global risk. The coming days will not just test supply chains, but market psychology itself, revealing how quickly confidence can shift when energy, politics, and power collide. The moment news breaks of a potential U.S. strike on Venezuela, oil markets would not wait for confirmation of damage, casualties, or actual barrels taken offline. Prices would move first, facts would follow later. This is how modern energy markets operate, driven less by immediate supply loss and more by perceived risk. Traders price fear faster than reality, and geopolitical conflict injects fear at scale. Even if Venezuelan production remained temporarily intact, the mere possibility of disruption would force traders to reprice oil with a higher risk premium almost instantly. Futures contracts would reflect not what is happening, but what might happen next, and that distinction is crucial. Markets are forward-looking machines, and in moments like this, expectation becomes price. Venezuela sits at a sensitive intersection of geopolitics and supply psychology. Its production volumes may not dominate global output, but its vulnerability amplifies its importance. Any military action introduces questions that markets hate. Will ports shut down? Will exports be sanctioned? Will shipping insurers pull coverage? Will counterparties refuse settlement? Each unanswered question adds another layer of premium to oil prices. This is why even rumors of conflict can move Brent and WTI sharply higher within minutes. Oil is not priced on certainty during crisis, it is priced on worst-case scenarios. And once that premium enters the system, it rarely exits quietly. There is also the contagion effect that traders immediately model. A strike on Venezuela would not be viewed in isolation. It would be interpreted as a signal of escalating geopolitical tolerance for direct intervention in energy-producing regions. That perception alone expands risk premiums across multiple producers, not just one. Suddenly, the market begins asking uncomfortable questions about supply chains across Latin America, shipping lanes, and even retaliatory responses. Could allies respond? Could sanctions tighten? Could other producers become leverage points? Each question adds dollars to the barrel before a single facility is damaged. The hook many miss is that oil prices often peak not at the height of disruption, but at the peak of uncertainty. When clarity is absent, volatility thrives. Hedgers rush to lock in supply, speculators pile into momentum trades, and producers hesitate to commit volumes forward. Liquidity thins, spreads widen, and price discovery becomes emotional rather than rational. In that environment, oil does not need a supply shock to surge, it only needs the credible threat of one. And once markets internalize that threat, the price response becomes self-reinforcing, feeding on fear, leverage, and the simple reality that energy is the bloodstream of the global economy. Beyond immediate price reactions, a U.S. strike on Venezuela would place global oil supply chains under intense structural pressure, exposing vulnerabilities that are normally hidden during stable periods. Venezuela's crude does not exist in isolation. It moves through a web of shipping routes, refining dependencies, financing arrangements, and insurance frameworks that are highly sensitive to geopolitical risk. The moment military action enters the equation, this web begins to tighten. Tankers hesitate, insurers reassess exposure, and refiners start recalculating feedstock availability. Even if barrels technically remain available, their ability to move freely becomes constrained, and in energy markets, constrained flow often feels indistinguishable from lost supply. One of the most underappreciated consequences is the refining mismatch that would follow. Venezuelan crude is heavy and sour, meaning only certain refineries, particularly in the United States, Asia, and parts of Europe, are configured to process it efficiently. If those barrels are disrupted, refiners cannot simply switch to lighter alternatives without cost or downtime. This creates a silent bottleneck where global supply appears adequate on paper, yet specific segments of the market experience acute shortages. The hook here is subtle, but powerful oil shortages don't always show up as missing barrels. Sometimes they show up as the wrong barrels in the wrong places. Shipping dynamics would amplify the strain. Any escalation raises the risk profile of Caribbean and Atlantic routes connected to Venezuelan exports. Higher insurance premiums, longer roading, and delays quickly translate into higher delivered prices. These costs ripple outward, impacting not just crude but refined products like diesel, jet fuel, and gasoline. Transportation costs rise, inventory cycles stretch, and suddenly downstream markets feel pressure that has little to do with Venezuela's actual output and everything to do with friction. Markets don't need total disruption to panic, friction alone is enough. There is also a financial choke point that rarely makes headlines. Venezuelan oil transactions already operate under complex payment structures due to sanctions and political risk. A military strike would harden those frictions further, pushing deals into narrower channels with fewer counterparties willing to touch the trade. When fewer players are willing to transact, liquidity evaporates. Prices then become more volatile not because demand explodes, but because participation shrinks. This is where supply chain stress morphs into market instability. The most important hook lies in timing. Supply chains do not adjust instantly. Alternative sourcing takes weeks or months, refinery reconfiguration takes time, and shipping capacity cannot be conjured overnight. During that adjustment window, even small disruptions can create outsized effects. The market is forced to bridge the gap with inventory drawdowns, emergency rerouting, and aggressive bidding. And once that scramble begins, it feeds itself, as every participant tries to move first rather than be left exposed. Oil markets react to military escalation long before a single barrel is removed from circulation, and that reflexive behavior is exactly what makes a potential U.S. strike on Venezuela so powerful as a price catalyst. Traders do not wait for confirmation of damage. They price risk, and they price it aggressively. The first response would likely be a volatility spike as algorithms, hedge funds, and institutional desks rush to reprice futures curves, widening spreads and pushing risk premiums higher. The hook many underestimate is this: oil prices do not rise because supply is gone, they rise because certainty is gone. And uncertainty is the most expensive commodity in the market. A strike would immediately inject a geopolitical premium into crude benchmarks, particularly Brent, which is more sensitive to global supply disruptions. Even if Venezuelan production losses were limited, the market would begin asking a far more destabilizing question: where does this escalate next? Energy traders remember that regional conflicts rarely stay contained, and the fear of spillover into shipping lanes, neighboring producers, or retaliatory actions becomes embedded into pricing. This is how a localized event transforms into a global price shock. The moment participants start hedging against worst-case scenarios rather than base cases, prices detach from fundamentals and move into defensive territory. That volatility would not remain confined to crude. Refined product markets would react sharply as well, particularly diesel and jet fuel, which are highly sensitive to supply chain disruptions and refining constraints. Airlines, shipping companies, and logistics firms would rush to lock in fuel costs, pushing demand forward and compressing available supply in the near term. This front-loading effect acts like an accelerant on prices, creating sudden spikes that ripple into transportation, manufacturing, and food supply chains. The hook here is uncomfortable but real. Energy inflation often begins invisibly, then appears everywhere at once. Currency and bond markets would feel the tremors almost immediately. Oil. Importing nations face deteriorating trade balances when prices rise, pressuring currencies and forcing central banks into difficult policy choices. Do they tighten policy to fight inflation, or ease to support growth under higher energy costs? Neither option is painless. Meanwhile, oil exporting countries outside the conflict may see windfall revenues, reshaping capital flows and investment patterns in ways that amplify global imbalance. Energy shocks rarely stay in energy, they seep into macroeconomic stability. Equity markets would struggle with the same uncertainty. Energy stocks might rally, but broader indices often falter as higher input costs compress margins and reduce consumer spending power. Investors begin rotating defensively, favoring commodities and hard assets over growth-sensitive sectors. What starts as a geopolitical headline quietly rewires portfolio behavior worldwide. The most powerful hook is psychological. Once markets experience a shock, they remain on edge long after the event fades. Risk premiums linger. Volatility becomes normalized, and every new headline carries disproportionate weight. A strike on Venezuela would not just move prices for days or weeks. It would reset expectations, teaching markets once again that energy security is fragile, political risk is underpriced, and stability is always more temporary than it appears. Beyond immediate price volatility, the deeper impact of a U.S. strike on Venezuela would unfold through global supply chains and inflation channels that most consumers only notice once the damage is already done. Oil is not just an energy input, it is the invisible cost embedded in nearly every good and service. When crude prices rise sharply, transportation costs follow within days, and that pressure quietly migrates into food prices, manufactured goods, and consumer services. The hook many overlook is this: energy shocks rarely announce themselves as inflation events at first. They disguise themselves as temporary logistics issues until price stability erodes across the board. For economies already grappling with elevated inflation and fragile growth, an oil-driven cost surge becomes especially dangerous. Central banks are forced into a policy corner. Allow higher energy prices to pass through and risk reigniting inflation expectations, or tighten monetary conditions into slowing economies and risk recession. Neither path offers a clean outcome. This is how geopolitical events thousands of miles away translate into higher borrowing costs, weaker currencies, and reduced purchasing power at home. Inflation is no longer just a domestic policy issue. It becomes imported, persistent, and politically sensitive. Emerging markets would feel the strain first and hardest. Many rely heavily on oil imports while carrying significant dollar-denominated debt. A spike in oil prices combined with a stronger dollar tightens financial conditions rapidly, draining reserves and pressuring local currencies. Governments are then forced to choose between subsidizing fuel, blowing out fiscal deficits, or allowing prices to rise, risking social unrest. History shows that energy inflation has a habit of exposing political fault lines, and markets are quick to price that risk. The hook is uncomfortable, but accurate. Energy shocks don't just move markets, they test governments. Global trade flows would also begin to shift. Higher fuel costs raise shipping expenses, making long-distance supply chains less economical and accelerating the trend toward regionalization. Companies that depend on thin margins and global sourcing face an immediate squeeze, while those with localized or energy, secure operations gain a competitive edge. This redistribution of advantage happens quietly but decisively, reshaping investment decisions and capital allocation across industries. What looks like a short-term oil spike can trigger long-term structural changes in how and where goods are produced. Financial markets absorb these signals faster than the real economy. Equity investors begin discounting slower growth, bond markets reprice inflation risk, and commodities attract defensive capital seeking protection against currency erosion. The strike itself becomes less important than what it symbolizes: a world where geopolitical risk is no longer an exception, but a baseline assumption. And once markets accept that assumption, pricing models change. Volatility becomes embedded, and stability carries a higher premium than growth. Financial markets would not wait for confirmation of damage before reacting to a U.S. strike on Venezuela. They would move instantly, pricing risk at the speed of fear. Energy-sensitive equities would surge and sink almost simultaneously as investors scrambled to reassess margins, input costs, and demand destruction. Oil producers might rally on higher crude prices, but refiners, airlines, transport firms, and industrial manufacturers would come under immediate pressure. The hook most people miss is this: market volatility in geopolitical shocks is rarely about winners and losers. It's about uncertainty overwhelming valuation models that depend on stability. Currency markets would become the first battlefield. Oil importing nations would see their currencies weaken as higher energy bills widen trade deficits, while commodity-linked currencies could spike unpredictably, driven more by speculative flows than fundamentals. The US dollar, often treated as a safe haven during global stress, could strengthen initially, tightening financial conditions worldwide and amplifying pressure on dollar-denominated debt. For emerging markets, this combination is toxic. Capital outflows accelerate. Bond yields rise, and central banks are forced to defend currencies at the expense of growth. The hook here is brutal volatility does not spread evenly. It concentrates where balance sheets are weakest. Equity markets would reflect this imbalance almost immediately. Investors rotate defensively, pulling capital from growth sectors and reallocating toward energy, defense, and perceived inflation hedges. Valuations compress not because earnings collapse overnight, but because risk premiums expand. When uncertainty rises, future cash flows are discounted more aggressively, and that alone can erase billions in market capitalization within hours. High leverage firms become especially vulnerable, as rising volatility pushes up borrowing costs and margin requirements. What looks like a geopolitical event quickly morphs into a financial stress test. Bond markets would send their own warning signals. Inflation expectations embedded in yields would climb as energy prices feed into long-term cost projections, while recession fears pull in the opposite direction. This tug of war creates yield curve instability, confusing signals that reflect a market unsure whether to fear overheating or contraction. Traders thrive in that chaos, but long-term investors struggle to find footing. The hook is subtle but powerful. When bond markets lose narrative clarity, risk assets follow. Derivatives and options markets would amplify everything. Volatility spikes drive up premiums, forcing hedgers to pay more for protection and pushing speculative players to either retreat or double down. Margin calls become more frequent, liquidity thins, and forced positioning starts to dictate price action. At that point, markets are no longer reacting to fundamentals, they are reacting to themselves. And once feedback loops take hold, even a limited military strike can ripple outward, reshaping global asset prices far beyond the oil market itself. Thanks for watching.